Green finance is everywhere these days. Banks are pledging billions, companies are talking net zero, and investors are going green. But here's the problem. Along with all the momentum comes a lot of myths, misunderstandings, and even outright misinformation. If you've ever wondered whether green finance is just greenwashing or whether it can actually drive real impact, then this video is for you. Today, we're busting 8 common myths that keep people confused about sustainable investing and climate finance. Welcome to Money and Planet, the channel where we break down the world of sustainable investing, climate finance, and the future of money on a warming planet. We believe that finance isn't just about numbers. It's about impact, responsibility, and the choices that shape tomorrow. If you're new here, make sure to stick around, because this video will clear up some of the biggest misconceptions around green finance, so you can make better, smarter, and more sustainable investment decisions. Myth 1. Green finance is just greenwashing. It's true that greenwashing exists. Some companies exaggerate their sustainability credentials, and some bonds or funds aren't as green as they look. But painting all of green finance with that brush misses the point. Independent verification, stronger reporting standards, and watchdog organizations are making it harder to fake impact. Investors are demanding transparency, and regulations are catching up. While greenwashing is a risk, the overall direction of sustainable finance is toward greater accountability, not less. Myth 2. Green investments don't perform well. Many people still think that investing sustainably means sacrificing returns. But decades of research now show the opposite. Funds with strong environmental, social, and governance criteria often match or even outperform traditional investments. Why? Because companies that prepare for climate risks, innovate in clean energy, or manage resources responsibly tend to be more resilient over time. In fact, ignoring sustainability may expose portfolios to long-term risks like stranded assets or regulatory penalties. Performance and responsibility can go hand in hand. Myth 3. Only rich people can afford to invest. Green, sustainable investing isn't just for wealthy individuals or institutions. More and more platforms now offer retail investors the chance to choose green funds, impact ETFs, or even climate-focused robo-advisors with small minimum amounts. Community banks and microfinance initiatives also provide ways for everyday people to support sustainable projects. Whether you're investing a few dollars or building a full portfolio, green finance is becoming increasingly accessible to everyone, not just the elite. Myth 4. Green bonds are too niche to matter. Green bonds, debt instruments designed to fund climate-friendly projects, used to be small in scale. But not anymore. The global green bond market has exploded past the $1 trillion mark and continues to grow. Governments, corporations, and even cities are using them to finance renewable energy, public transport, and sustainable infrastructure. Far from niche, green bonds are becoming mainstream, attracting investors who want both steady returns and positive environmental outcomes. Their scale now rivals that of traditional bond markets. Myth 5. Green finance is just about climate change. Climate change is central, but green finance covers much more. It includes biodiversity conservation, water protection, pollution control, sustainable agriculture, and circular economy initiatives. Then there's blue finance, which specifically targets ocean and water-based sustainability projects. Thinking of green finance only as climate finance is too narrow. In reality, it's a broad umbrella that connects capital to the full spectrum of environmental challenges we face. It's about building a sustainable system across land, water, and air. Myth 6. Fossil fuel companies can't be part of green finance. Some assume that oil and gas companies should be excluded entirely. But transition finance, helping high-emission industries shift to cleaner operations, is a crucial piece of the puzzle. Not every project by a fossil fuel company is green, but financing carbon capture, renewable expansion, or methane reduction initiatives can have meaningful impact. The debate is ongoing, but the reality is, to reach net zero, even the most carbon-intensive sectors will need access to capital to transform themselves. Myth 7. Green finance is just a trend. Skeptics often call sustainable investing a fad, something fashionable but temporary. The numbers prove otherwise. Global ESG assets are expected to surpass tens of trillions of dollars in the coming years. Investor demand, regulatory changes, and consumer pressure are all aligning to make green finance a permanent shift, not a passing phase. As climate risks intensify, sustainable finance is increasingly seen as smart risk management rather than charity. It's about survival in a rapidly changing economy. Myth 8. Individual investors can't make a difference. It's easy to feel powerless when global finance seems so massive, but investors collectively shape markets. Every choice, whether moving money into a green ETF, supporting a sustainable pension fund, or pressuring banks to disclose climate risks, adds up. When millions of individual investors demand better, companies and governments respond. Change in finance happens through momentum, and every dollar is a signal. Individual investors aren't powerless. They're essential to scaling the transition to a sustainable economy. Busting myths is only the first step. What really matters is how this knowledge changes the way we invest and make decisions. The future of green and blue finance depends on better understanding, stronger standards, and collective action. By separating fact from fiction, we can direct capital where it makes the biggest impact, for both returns and the planet. Now that we've busted these myths, we'd love to hear from you. Which of these myths did you believe before watching this video? Do you still think some of them are partly true? Or are there other misconceptions about green finance you'd like us to tackle? Drop your thoughts in the comments. We read and reply to as many as we can. To recap, green finance isn't just greenwashing. It can perform well, and it's not limited to the wealthy. Green bonds matter, the scope is broad, transition finance is real, and this is no passing trend. Most importantly, individuals do have power. Together, finance can shift from a driver of climate change to a driver of solutions. If you found this helpful, give the video a like and share it with someone who's curious about sustainable investing. Subscribe to Money and Planet for more insights into green and blue finance, and let's build a smarter, more sustainable future together.